Hi, I'm Jimmy. In this video, we're going to look at a few different ways to see how over or undervalued the stock market is today. It's overvalued. Although this would work if it was also undervalued. We're going to use indicators like the Warren Buffett indicator, the overall PE ratio of the stock market, and then the Shiller PE ratio, which also accounts for inflation. Then after that, we're going to take a peek at some of the sectors within the S&P 500 to see which sectors look more overvalued or more undervalued. Okay, so let's dive into this thing. So up first, we have the Warren Buffett indicator. And basically what the Buffett indicator does is it takes the size of the entire stock market, the market cap of the entire stock market, and compares that to the size of the United States GDP. Because the theory is that if GDP rises, so if the overall country gets bigger, well, it's understandable that the stock market would also get bigger. And we can see that the Buffett indicator goes all the way back to 1971. And right now, the Buffett indicator is at the highest level it's been in this entire time period. In fact, the Buffett indicator comes in at about 204%. So basically, this means that the stock market right now is valued at more than double of the gross domestic product of the United States. So clearly, the stock market, according to this indicator, is way overvalued. But what about the more traditional price to earnings ratio? And then we'll look quickly at the Shiller PE ratio so we can account for how inflation is affecting all of this. So this is the price to earnings ratio for the S&P 500 going back to 1955. And as we could see, well, once again, the stock market today is stupid high. Right now, the PE ratio for the S&P 500 is about 33x. So basically what this means is that for every dollar of earnings or profit, earnings and profit are the same thing. Well, for every dollar of profit, we will pay $33 to buy into that on average. Okay, so just looking at this chart, well, we can see that the current level is quite high. And that's probably a bad thing. But I do think that we should at least acknowledge the fact that there are some outside influences affecting how this chart might look. For example, back here in this time period, well, the average PE for the stock market during that time period was quite low. Well, during that time period, interest rates were in the United States were very, very high. We're talking double-digit interest rates, call it 12, 13, 14, sometimes higher percent for government bonds, never mind corporate bonds. So if we could buy a government bond and let's say return 14%, well, why would we invest in stocks, government bond? Why would we invest in anything more risky than a government bond if government bonds are going to pay that well? So in theory, that would lead to less investments in the stock market. The result? Lower PE multiples. And today, well, interest rates are crazy low. They're the exact opposite situation. Now, I'm sure that many of us are aware that the Treasury has done what they can to stimulate the economy and keep interest rates as low as possible. But the real issue going forward is going to be what happens if interest rates begin to rise? What happens if inflation begins to rise and the Treasury is then forced to do something about that? Their most logical weapon is to increase interest rates. Well, if they do that, what happens to the stock market? But either way, I believe that with where interest rates are, there should be a naturally higher level, a higher average for the PE multiple. 33 is way too high, in my opinion. I think you could make the case for 20, maybe low 20s, even slightly below that, but call it 18 to 23, I think would be reasonable. I think that would be a reasonable range. Maybe if 25 if you were talking higher growth companies, but 33 is way too big from my perspective. Okay, now what happens if we adjust the price to earnings multiple for inflation and smooth things out a bit? Because in theory, inflation should move the stock market higher. Naturally, it should move up by about the same amount as inflation, give or take. And luckily for us, they've already done this with the Shiller PE ratio. We might also hear this called the CAPE 10 ratio. CAPE is short for cyclically adjusted price to earnings ratio. And basically what Robert Shiller did, Robert Shiller was the creator of the Shiller PE ratio. He's a professor over at Yale. And basically what he does is he takes the average earnings over 10 years, over a 10-year period. So that smoothes out earnings, sort of smoothes out some of the business cycle. So we end up with smoother earnings, and then he adjusts everything for inflation. So what we're left with is a much cleaner look at how profits are really growing. What is the real growth of the companies within the stock market? And we can see that once again, the stock market, according to the Shiller PE ratio, does look overvalued. Now, this indicator isn't quite as obscene as some of the other stock market indicators that we looked at. For example, the tech bubble was worse than it is right now. But if we think about it, the stock market back then, during the tech bubble, the stock market was fueled by companies that didn't have any earnings. So that's really going to hurt the overall averages, and I get the Shiller PE ratio back then being stupid high. So ignoring the tech bubble, which was a bit unique, well, we can see that the current level of the Shiller PE ratio is higher than every level before it, even the Great Depression. So yeah, this is terrible for value investors. But if we think about the tech bubble and the crash of the tech bubble as the tech bubble was bursting, just as one example, well, not all stocks have the same results. Just to illustrate, this is the S&P 500 from the end of 1999 to about March of 2003. And we could see during this time period, the S&P 500 was down about 43%. And during that same time period, well, tech stocks like Cisco, well, they were down a bit more than 75%. Apple was down like 72%. Again, that makes sense given that those companies were tech-related companies, and that was a lot of the reason the stock market was overvalued at that point. But if we had invested our money in more defensive companies like Caterpillar, well, during this very same time period, they were up about 4%. Johnson & Johnson, well, they were up about 23%. 3M was up about 33%. So clearly, an overvalued stock market doesn't necessarily mean that all stocks are going to react the same way on the way down. So with that in the back of our minds, this is the current price to earnings multiple for each of the 11 sectors in the S&P 500. These are broken out by GICS sectors. And there are a few points we should be aware of here. First is energy stocks. We can see that we don't have a PE multiple for energy stocks, and that's because over the past 12 months, well, profits are negative for these energy companies. So PE doesn't work for them. Then we have real estate. We can see that with real estate looks like their PE multiple is super high. But that's not real. It's because PE is bad to use for something like a REIT, a real estate investment trust. Better than using the PE multiple would be use something like funds from operations. So either way, it's probably better if we ignore that sector from a PE perspective. And then something like financials. Well, financials here look fairly low, and perhaps some of them are, but better than price to earnings for financial stocks would be something like price to book value. So again, I think it makes sense for us to at least ignore these in this context. If we wanted to use a price to earnings multiple for either one of these sectors, well, we'd really have to compare it to its own history to see how it stacks up today. Or better yet, switch to funds from operations for real estate or price to book value for financials and go from there. But either way, we can see that many of these sectors are still overvalued. Something like consumer discretionary. Well, that looks way overvalued. Although something like consumer staples, which tend to be more defensive names, well, they look like they could be at least decent at this point. Relative to the group, they could be undervalued. Although I'm not sure they're completely undervalued compared to their own history. Now we've also got some other defensive names, something like utilities or healthcare. Both of them look like they could be, relative to the group, something we should look at. So perhaps these could make solid investments at this, some of them from these sectors could make some sense going forward. That way, if the stock market did pull back, well, at least we have an opportunity to do well over the next few years. And one big advantage of these types of companies, more defensive names, is that many of them tend to pay very good dividends. And that can be nice, especially if the stock market is heading down. If the stock market is tumbling and we own stocks that are paying dividends, if they continue to pay those dividends, a lot of times that can sort of soften the blow for us. So if we can find defensive names that are not too overvalued, and that we believe will continue to pay their dividends, well, I think it could make sense to use something like a dividend reinvestment plan for those types of stocks. Now, personally, I'm not using dividend reinvestment plan in the stocks that I own. Now, I actually recently did a video where I walked through some of the advantages and disadvantages of signing up for a dividend reinvestment plan. So if you're curious, perhaps that's a good next video for you to watch. I got a link right here. I got a link in the description below. And thank you so much for sticking with me all the way to the end of the video. I really appreciate it. Thank you, and I'll see you in the next video.